Hi, my name's Steve Bainbridge. I'm a corporate law professor at UCLA, and this is my third video on valuing businesses in legal settings. And it's particularly applicable to what are known as appraisal proceedings that are available in connection with mergers. Today, we're going to talk about the capital asset pricing model and its use in calculating discount rates. Now, the capital asset pricing model was developed to figure out what the rate of return is likely to be on a particular asset. As investors, we want a rate of return that compensates us for taking on risk. Risk and return go hand in hand, of course. If you want me to take on greater risks, you're going to have to pay me a higher rate of return. The capital asset pricing model helps us to calculate investment risk and what return on investment we should expect. Here we look at the formula behind the model and what the CAPM is used for in a legal setting. Now, CAPM is somewhat controversial in financial economic circles. There are alternative asset pricing models out there. But in the courts, CAPM remains the predominant means of determining the rate of return that we would expect, particularly on equity securities. It's used both in Delaware, which, as I'm sure you know, is the leading state in US corporate law, but it's also used in other courts and other settings. In the Fourth Circuit, for example, it's been used in calculating pension returns and so forth. Now, as I mentioned at the outset, risk and return are the two most important and most basic attributes of an investment. And in addition, they go hand in hand. As the risk goes up, the return that you have to pay investors for bearing that risk also goes up. And this is a basic principle that all asset pricing models accept. Now, of course, when we talk about risk, we aren't just talking about the risk of default, which is how we normally use risk in colloquial settings. But rather, we're talking about volatility risk, the possibility that the actual return on an asset will be different from the expected return. Well, this is a very simple example. Suppose that you have an investment that has three possible outcomes, depending on the general economic conditions. If the economy is booming, your company will earn a profit of 100%. If the economy is in a sort of normal, steady state, you'll earn a return of 15%. But if the economy plunges into recession, your company will earn a negative 70% rate of return. Now, how do we determine the expected return on investing in this company? Well, take the nominal rate of return that you'll earn when the economy booms, 100%, and multiply that by the probability that the economy will be in a boom condition, which is 30%. To that, you would add the nominal rate of return, 15%, that you would earn in a sort of normal economic conditions, and the probability that normal economic conditions will prevail, which is about 40%. And finally, you would multiply the nominal return that you would receive in the event of a recession, which would be a negative 70%, and multiply that by the probability that the economy will be in recession, 30%. And if you do all those sums, your expected return on this investment would be 15%. Now, of course, the fact that the expected return is the same as the economic return in normal times is simply an artifact of the numbers. That's normally not the case. But what the point illustrates is that any investment has a number of possible outcomes. And in order to assess the expected return on that investment, you have to sum up all of the possible outcomes by multiplying their probability times the nominal return if that state of the world comes to being, and then adding them all up to get what in effect is a weighted average rate of return. Now, the capital asset pricing model is closely linked to what's known as portfolio theory. Imagine you have an island economy with two businesses. One sells suntan lotion and prospers when the vacation season is more sunny than average. The other sells umbrellas and prospers when the vacation season is more rainy than usual. I didn't invent this hypothetical. You'll see it in a number of corporate finance textbooks. Well, suppose that investor A puts $1 into the suntan company. Her expected return is 12%. Conversely, suppose the investor put $1 into the umbrella company. Well, again, her expected return would be 12%. But if she only invests in one of the two companies, she's undertaking a substantial amount of risk. If she invests in the suntan lotion company, then 1/3 of the time, she'll end up with a negative return on her investment. And only 1/3 of the time will she make the significant 33% profit. And some investors would prefer less volatility on their returns. They would prefer to eliminate some of the risk that's associated with making these investments. Well, how might our hypothetical investor be able to do that? Well, suppose what she did, instead of investing $1 into one of the companies, she invested $1 into each of the companies. Now, what would be her return under the various weather conditions that we've hypothesized? Well, if the island economy goes through a sunny weather period, then the suntan lotion would return 33%. The umbrella company would return -9%. To determine what her return would be in the event of a sunny weather conditions, multiply half. She put 50% of her money into the suntan lotion company, times the 33% rate of return it would earn, plus half, again, 50% of her money went into the umbrella company, which would earn a -9%. When you run the numbers, that means that she would earn 12% on her total portfolio in the event that sunny weather conditions prevail. But notice that she would also earn 12% if normal weather conditions prevailed, and 12% if rainy weather conditions prevailed. In other words, no matter what the weather conditions, her portfolio has now diversified away weather risk. It won't matter whether it's sunny, rainy, or normal, she's going to earn 12%. Now, of course, this is a very simple hypothetical, but it does hold generally that diversification reduces risk. We see this in this chart, which suggests that if you hold a diversified portfolio, sometimes one set of stocks will be doing well and the other set of stocks won't be. And over time, these stocks, which are what an economist would say are negatively correlated, would cancel each other out. So what are the lessons from our vacation island hypothetical? Well, first, combining securities into portfolios reduces risk. It does so by canceling out complementary variations in the risk associated with the various securities that make up the portfolio. Now, to some extent, all stocks tend to move in tandem. Our hypothetical has two stocks that have a complete negative correlation. And that's very, very rare. Moreover, we're really only focusing here on one risk. And there are a lot of different types of risk that we have to take into account. But generally speaking, risk can be divided into two basic categories. First, what are known as firm-specific risks or unsystematic risks. And secondly, systematic risks. Firm-specific risks, also known as unsystematic risks, are unique to a company. It's the threat of competition. It's the likelihood that key leaders will leave the company. It's the risk that the company's product will suffer defects. Systematic risks are risks that affect all companies. Changes in interest rates, for example, trends in the overall economy, inflation. Investors are able to eliminate their exposure to most firm-specific risk by maintaining a diversified portfolio of investments. Systematic risks, however, can't be diversified away because they apply to all companies. Still, some companies are more vulnerable to systematic risks than others. And the more vulnerable your company is, the higher the rate of return your investors will expect. Here we see some examples of unsystematic or diversifiable risks. Strikes, your plant burns down, you get hit with a major lawsuit, you've got a bad boss. Firm discovers gold under its property, et cetera, et cetera, et cetera. The key thing is that these events are random and they're unrelated across firms. For assets in a portfolio, some surprises are positive, some are negative. In a well-diversified portfolio, you might very well find that a risk that injures one company benefits another. If one company's workers go out on strike, then a company whose workers aren't on strike will get a competitive advantage. Systematic risks are those that are positively correlated with each other. They reflect an economy-wide influence that affects all companies. And this would be things like your business cycle. Are we in a recession? Are we in a boom? Inflation shocks, such as what we're arguably experiencing, now in the fall of 2021. Productivity shocks, interest rate changes, major technological changes, perhaps even eventually a zombie apocalypse. These are economic events that are going to affect all assets in a similar way. And the risk associated with those events simply doesn't disappear in well-diversified portfolios, as they tend to affect all firms in much the same way, although again, not to the same degree. The effect of diversification, then, is that you can eliminate unsystematic risk, but not systematic risk, by holding a well-chosen diversified portfolio. Economists tell us that by holding between 20 and 25 different stocks in a portfolio, you can eliminate virtually all firm-specific risk. But these have to be well-chosen firms that are in widely diverse industries. If you loaded up your portfolio with 25 high technology stocks, that's not going to be a well-diversified portfolio, and you're not going to get the full benefits of diversification. If you really want to be diversified, of course, you would invest in an index fund, such as a mutual fund that mirrors the S&P 500, where you would have a very, very large number of companies in the portfolio. And that would assuredly eliminate unsystematic risk. Now, as I mentioned, firms differ in their vulnerability to systematic risks. In a recession, manufacturers of large, expensive products tend to take a very significant hit. If you're a car maker, or you make appliances, or other types of consumer durables, your sales are going to drop significantly in a recession. Investors, consumers will put off buying a new car for a year or two if they're worried about losing their jobs, if they're worried about having to invade their savings. On the other hand, during a recession, some companies will probably not take as big a hit. Think about consumer non-durables, things that are consumed, food, for example. People still have to eat in a recession. So a food company or a beverage company is typically not going to take as hard of a hit in a recession as a car maker or an appliance maker. And we can measure a firm's sensitivity to systematic risk by calculating a coefficient known as beta. Calculate beta. It's actually a very complicated process that involves measuring over certain time periods the return on the security in question and plotting it on a graph against the return that the market as a whole earned during the same period. And you gather over time a large number of these data points. And having plotted them on a graph, you draw what's known as a least squares regression line through them. And the slope of that line is beta. As I say, that's a very complicated process. And fortunately, we don't have to do it. There are a number of financial data firms, such as Morningstar, that calculate betas for us. And these are readily available, although they'll often charge you. But you can get a company's beta fairly easily. Now, as I say, beta is a measure of how sensitive a particular stock is to changes in the market. And basically, if you have a beta greater than 1, the stock is going to react more strongly to changes in economic conditions than the market as a whole. So that if you have a stock that has a beta of greater than 1, when economic conditions are good, it's going to be going up faster than the market. Its rate of return will be higher than the market rate. Conversely, if you have a security whose beta is less than 1, that security is less sensitive to market developments than the market as a whole. And so if the market goes up, a low beta stock won't go up as fast as the market. The advantage of that, though, the flip side of that, is that when the market's going down, low beta stocks go down less than the market. High beta stocks go down further than the market. And so if you're risk averse, you would prefer low beta stocks. If you're a risk preferer, you're going to prefer high beta stocks. Now, what does all this have to do with valuation? Well, beta is a critical component of the capital asset pricing model. And as we've seen, the capital asset pricing model is a method we can use to determine the rate of return that can be expected on an investment. And in particular, we use what's known as the classic capital asset pricing model formula. R sub C is the expected rate of return on an asset. And it equals R sub F, which is the rate of return that we would expect on a risk-free investment. Now, in the real world, there's no such thing as a true risk-free investment. But United States short-term Treasury obligations are generally regarded as being as close as you can get to a risk-free investment. R sub M is the rate of return that's being earned by some market benchmark, like the S&P 500 or the Russell 3000. Finally, beta, as we've seen, is the coefficient representing the security's risk sensitivity. And using this, we can calculate the rate of return that we expect on a particular investment. So let's see how we would do that. Well, let's start with stock number 1. And let's assume that the risk-free rate is 7%. That the rate of return being earned by the S&P 500 is 15%. And that stock number 1 has a beta of 1. Well, multiply beta of 1 times the market rate minus the risk-free rate, 0.15 minus 0.07, 1 times 0.08 gives you 0.08. So 0.07 plus 0.08 gives you an expected return on this stock of 0.15 or 15%. And as we predicted, a stock that has a beta equal to 1 is going to have a rate of return that's the same as the market rate of return. Now, stock number 2 has a below market beta. It has a beta of 0.7. Everything else remains the same. The risk-free rate remains 7%. the rate of return on the S&P 500 remains 7%. Excuse me. Everything else remains the same. The rate of return on the S&P 500 remains 15%. The rate of return on the risk-free rate remains 7%. So 0.15 minus 0.07, 0.8, times 0.7, the beta, equals 0.56. Add it to the risk-free rate, and the rate of return that we would expect on stock number 2 is 0.126 or 12.6%. And again, just as the theory predicted, the expected rate of return on this stock is below the expected rate of return on the market because it's got a beta of less than 1. Now, how can we use this? Well, we can use it by using the expected rate of return as the discount rate. The discount rate is simply the opportunity cost of capital adjusted for risk. In valuing corporations, one must use a weighted average cost of capital. That is to say, what does it cost the firm to raise money by selling equity securities? Plus, what does it cost the firm to raise money by selling debt securities? And you have to weight that according to what percentage of the firm's capital structure is comprised of equity and what percentage is comprised of debt. Because the company can take a tax deduction for the interest it pays on debt securities, but not the dividends that it pays on stock, you also have to adjust the debt side of the equation to reflect that deduction. Now, how does the capital asset pricing model fit into all of this? Well, we use the expected rate of return as the cost of equity. And the weighted average cost of capital is the discount rate that we use in all of our dividend discounted valuation models. It's also the discount rate that we would use in the discounted cash flow model. You can see this in the illustration that lists the various steps in the process. In conducting a discounted cash flow valuation, you start off by calculating the future free cash flows the company will earn over some period of time. And then you estimate the company's weighted average cost of capital. And using that, you then discount those future cash flows back to their present value. This is a basic part of valuation in the courts. Here we see from last year, a case in the Delaware Chancery Court that talks about how it calculated the weighted average cost of capital and thus how it calculated the discount rate. This model uses a slightly different formula for calculating the rate of return that's expected on the firm's equity. There's an alternative formula that calculates the expected return on the asset by multiplying beta times the expected rate of return on a risk-free asset plus what's known as an equity premium. How much more over and above the risk-free rate do you have to pay somebody to get them to buy stocks instead of buying treasury bills? And that's a perfectly legitimate way of doing the calculation. And it usually comes up with essentially the same numbers. In this instance, in the cruise case, they use the equity premium method. But at the end of the day, what you're coming up with again is the weighted average cost of capital and a discount rate that you can then plug into discounted cash flow analysis. If you're using the equity premium approach, the equity premium will depend in part on the size of the company. A small company premium is going to tend to be higher than that of a larger company because they tend to have higher rates of return.